The next step is to calculate your direct labor budget. The direct labor budget also starts with the number of units you need to produce. However, you need to figure out how much hours are used for each unit. So you multiply that by direct labor hours per unit to give you the total direct labor hours needed. Once you get your total direct labor hours, you have to multiply that by the cost per direct labor hour. So your cost of direct labor to give you total direct labor cost. And you would prepare your direct labor budget based on that. After your direct labor budget, the next step is to calculate your manufacturing overhead budget. Manufacturing overhead budget, what you need to do is you need to know the cost behavior that you learned in your previous chapters and apply that to your manufacturing overhead. You need to split your variable overhead and your fixed overhead and then calculate a total overhead budget. However, the key here is again separating your variable overhead and fixed overhead. You know that variable overhead varies with production volumes, which each month has different production volumes. But your fixed overhead costs, you just take whatever they give you. So whenever you're preparing your budget for your variable overhead, you're going to calculate how much the variable overhead for each month's production. But for fixed overhead, you're just going to take the numbers that they gave you straight across. Again, you're going to set up your manufacturing overhead budget as quarters on top going across and then your descriptions going down. You're first going to calculate your variable overhead. So you start with the number of units to be produced, which they've already given you, and you would put those numbers across the board. For the total units to be produced, you're just going to add up your quarter 1, quarter 2, quarter 3, and quarter 4 figures. Then you know that your variable cost per unit, variable overhead cost per unit is 45, which they've also given you. Now you can calculate your budgeted variable overhead, which is done by multiplying the number of units to be produced by your variable overhead cost per unit. Once you get your budgeted variable overhead, you're going to next calculate your budgeted fixed overhead. There were two items that they had given you. The first item was depreciation. Depreciation does not vary with changes in volume. The next thing was supplies and insurance. Those also don't vary with changes in volume. However, they anticipated different amounts being incurred during the different quarters. So you take your fixed overhead and you put it all the way across for a year, you get 12,000. The supplies and insurance, again, you take the numbers they give you. You don't multiply it by anything. The reason that these numbers differ is they anticipate different amounts of usage for supplies and insurance. Again, then for the total, you would sum all those 4 quarters up. The total budgeted fixed overhead is just simply the sum of all your different fixed overhead. So you would add your depreciation 3,000 plus your supplies and insurance 5,000 to get a quarter 1 fixed overhead of 8,000, and you would do this for all the quarters. Finally, to calculate your total budgeted manufacturing overhead, you're just going to add up your variable overhead component plus your fixed overhead component for each quarter and total for the year. Once you have your overhead budget, you're just going to calculate your operating expenses budget and then finally your budgeted income statement. That brings us to the end of your operating budgets. The next step is to prepare your financial budgets. Your financial budgets are made up of several components. You start off with your capital expenditures budget, cash collections budget, cash payments budget, or you do a combined cash budget. And then you have a budgeted balance sheet. All these fall into your financial budgets. A capital expenditures budget is simply a budget that shows the company's plans to invest in new property, plant, or equipment. We call these capital investments. A cash collections budget is basically when does a company expect to receive cash flows from its sales. A cash payments budget is the opposite. When will a company pay for its direct materials, direct labor costs, manufacturing overhead costs, and operating expenses? Also, don't forget to take into account capital expenditures and income taxes. All those will be in your cash payments budget. A combined cash budget combines cash receipts and cash payments, and sometimes even takes into account if there's any excess money, you would be investing that money, or if there's a shortfall, you would have to borrow funds. Finally, let's go back to operating budgets and talk about something that we didn't talk about at that time, which is cost of goods sold budget. A manufacturer prepares a production budget and then direct materials, direct labor, manufacturing overhead. However, if you're a merchandiser, you don't have production budget, you have a cost of goods sold, inventory, and purchases budget. So for a merchandising company, your cost of goods sold budget starts off with cost of goods sold. How do you calculate cost of goods sold? In your questions, they will tell you this is our sales for the following quarter or following months. And then they will tell you that cost of goods sold is a certain percentage of sales. They may say cost of goods sold is 50% of sales, and that will enable you to calculate cost of goods sold. Remember, this is a cost of goods sold budget, which means it's all in dollars. Unlike your production budget, which is all in units, the cost of goods sold budget is in dollars. So you start with your cost of goods sold, and to that, you add your desired ending inventory. They will give you the information to calculate it, which equals total inventory needed. Then you subtract your beginning inventory, and that will give you your purchases of inventory. Again, keep in mind the whole budget here is done in dollars and there are no units involved. Also, if they give you a beginning inventory or an ending inventory, you would use those numbers. Otherwise, you would use the numbers they give you to calculate those amounts.